we're going to go through essentially a bit of the whole life cycle of investing in these accounts, trying to figure out which one makes the most sense. How do we look at the drawdowns later on in life? And everything in between. Any advice that we're going to give here is not meant to replace the advice of your accountant, lawyer, tax professional. Certainly, when it comes to RSP contributions or any other limits, double check that it is right for your particular set of circumstances. By all means, reach out to our team, talk to Clinton, talk to Kevin, talk to myself, and make sure that you're getting, the right advice for your particular set of circumstances, as this presentation is certainly a bit of a catch-all when it comes to these topics. All right, there's my lovely mugshot. So as they mentioned, I am Adam Buss, the Wealth and Estate Planning Specialist here on the team, one of the resources that Clinton and Kevin have access to for all of your financial planning and insurance needs. Again, here to assist you with that. I wouldn't be doing my job if I didn't do a shameless plug as to everything that I kind of look after here as part of the service offering. So, of course, the center of every discussion is the client, along with the investment advisor, making sure that we are looking after well rounded solutions. So, tax, legal advice along the way involving those professionals, investment advice. My job is primarily to look after financial planning, but of course, all of this is part of the services that we can offer or help coordinate for you as our clients. When it comes to any, retirement planning, do you truly know how much money you need to actually maintain your standard of living? Most Canadians have no idea as to, well, A, what they're spending today, and B, how is that spending need going to change in retirement time? Anytime we do financial planning, especially when it comes to the retirement side, it's important to know, what is your budget today? How much do you have extra today as surplus cash flow that you can save towards one of these things that we're going to talk about today? They mentioned the alphabet soup. Do you have $200 a month to save to RSP, TFSA, FHSA, or anything else of the acronyms that we have to work with? Or do you not even know how much extra cash you have? It's hard to really put a strategy in place until you've identified what amount extra you have to put aside. Okay. And of course, life happens. The best laid plans can certainly be derailed by having, something unexpected happen in life. I think I've mentioned this before. I mean, it's still good to have a plan. It's good to revisit that plan every couple of years, make sure everything's on track, sorry. And, things may go off course, but our job is to help steer you back in the right direction and give you the peace of mind that, yes, everything is still on track along the way. Um, Everybody's favorite topic, especially at this time of year. So, taxes. Everybody loves taxes. So, just an example here of what is the tax bracket for $80,000 of income in all the different provinces and territories here in Canada. As you can see, there is some variation between all the different provinces as to what tax rate you're going to pay at that level of income. And again, that's the marginal tax rate. That is not necessarily your overall tax rate that you're paying on every single dollar earned. Okay. Again, just recapping, the tax brackets are tiered and based on, each different dollar is taxed at a different rate. You know what? I have a great example on the next slide, so let's cover that one there. Now, of course, this is going to be Manitoba only in this particular case, but again, similar chart would exist for all the different provinces and territories. So again, just to recap, in this case, first $47,000 of income, approximately taxed at 25.8%, and then between 47 and 55,000 and change would be 27.75%. And then again, so on and so forth. So, if you're making $100,000, it's not like every dollar was taxed at 33.25, only the amount earned above 55,867. So again, that's very important that we want to plan for when it comes to trying to decide between RSP and TFSA contributions or even the FHSA as to which account is the right one to put into along the way. Now, of course, it is RSP season, so we do need to discuss what is the contribution limits that you can put into these accounts. So the 2023 RSP limit is $30,780. But wait, why are we talking about 2023 limit when it is 2024 right now? Because you are contributing at this time of year until the end of February towards your 2023 taxes. So we do need to know your contribution room and what the limit is for 2023 specifically. Now, how is RSP room calculated? Now, that is a max contribution limit provided you had enough earned income to generate that room. Let's see here. 2024 RSP limit does go up. It does go up every year with inflation. TFSA limit, I'm going to come back to that one. On the RSP room, we do want to look at, as an example, if you earned $100,000 of salary in the prior year, you get 18% of that amount. So even though the max is just over 30,000, your RSP room might only be $18,000. And how does this number change if you didn't have what's called earned income? Perhaps you just had dividend income. Maybe that's from investments, or maybe that's from your own company. What if you just had investment income? What if you have pension income? How does that all impact the room that you have available for an RSP contribution? So those are important things to look at. And when it comes to the TFSA, last year the limit was $6,500 of new TFSA contribution that you get. And now that we're in January, as of January 1st, the limit was raised. So now you get $7,000 of new contribution room this year. If you have $7,000 extra kicking around, you're not sure what to do with it, I'm sure Clinton and Kevin can certainly help you out with that. Total lifetime limit. So if you've qualified, you've been over the age of majority the entire time period, you've been in Canada a resident the entire time, you would have $95,000 of unused TFSA room. Okay. Now, again, you do want to double check to make sure that that room applies to your particular set of circumstances. Maybe you have more room. Maybe you've done a withdrawal from the account in the past. Those are things to look at and that you'd want to check online or with CRA Service Canada just to double check what your room is. So again, what impacts your eligible RSP room? Defined benefit pension plan. If you're one of the people that are fortunate enough to have, a guaranteed pension stream in retirement, the government says you can't double dip and get the best of both worlds. You can't contribute the maximum to your RSP and have this lovely defined benefit pension plan in retirement time. So they lower your RSP contribution room based on how the defined benefit pension plan contributions happen. So you would see a reduced RSP room limit on an annual basis as a result of that. Other things to factor in: do you have a matching RSP through work, or a DCPP, or as we call a defined contribution pension plan, where it's not necessarily a guaranteed payment stream in retirement? It is uh, basically like an RSP that both the employer and employee contribute to. So again, both those contributions are going against your RSP contribution room. And of course, check your notice of assessment for your total unused room. If you can't find your notice of assessment, you can go online. You can also attempt to call the government to get your RSP unused contribution room. There is an automated system as long as you have some of your tax numbers handy. Certainly, they can give you that number through the automated system. But the easiest is going through the My CRA website. Has your RSP limit, has your TFSA limit, has some of your tax information. It's fantastic when it is up and running. What happens if you over contribute to your RSP? Well, there's a $2,000 over contribution room limit that you can go with before actually getting a penalty. So that's more designed to, let's say you miscalculated your RSP room. So instead of penalizing you, they do allow a little bit of wiggle room when it comes to that contribution. So certainly something to keep in mind, but you also need to factor in, well, what happens if you don't have more earned income in the following year? If you've over contributed, you might not be able to deduct that amount in a future year. Also, check your notice of assessment if you have any undeducted RSP balances. That is where, perhaps, as an example, last year, if I would have put in $50,000 to my RSP, but I chose strategically tax wise to only deduct 25,000 of it in that particular tax year, I would have 25 still available to carry forward and deduct in a future year, even though the money's been in my RSP the entire time. But you do, again, need to use that room at some point in time. Otherwise, you would get taxed when you put it in because it hasn't been deducted yet. And you might get taxed, or I should say, you would get taxed when you take it out of the account later on. So, a double layer of tax, which is obviously no fun. So, these are things that you want to work with your advisor and your tax professional on. Life cycle savings options. So, as they mentioned in the beginning, there are so many different choices, especially now with the introduction of the first home savings account. There's more choices that Canadians have to save. But what do they mean, and what is the actual right choice for your particular set of circumstances? So let's go through the basics here. RSP contributions. So they are tax deductible. Dollar for dollar deduction. You contribute $10,000 into your RSP, your income gets reduced by $10,000, thereby not paying tax on that $10,000. That may lead to a tax refund. That may just mean that you don't have to pay a tax bill at the end of the year. Depends on your withholding tax throughout the year. It is a deduction that can reduce your income to a lower bracket. So as I showed on a previous slide, there's that 55 to $100,000 range as an example. Maybe it's enough RSP contribution to get you out of a slightly higher tax bracket and drop you into a lower marginal tax rate. Defers taxes to a later date when your income is potentially lower. That is the idea. That is the whole concept behind RSPs. Besides, trying to save money for retirement, the whole point is to put it in at a higher tax bracket, save that amount of money, take it out in retirement, hopefully at a lower tax bracket. It's another way of doing income splitting in retirement years. You can contribute to a spousal plan to further split income, and you can contribute up until the end of the year that you turn 71. Helpful things to note as well when it comes to the spousal plan. How it works is, you know, let's say Clinton and his wife as an example. So Clinton contributes to her plan. He gets the tax deduction. She gets to take the money out in retirement time. Okay, so that's again just a way of income splitting proactively. There is a 3-year attribution rule on those funds, which means if the money comes out of the account within 3 years, then it is taxed back to the original contributor. So things to be aware of, just to make sure that we're accounting for long-term tax planning, not just the short-term. I think
Yeah,
Clinton has joined me here.
I did. I popped on the screen. You kind of answered the question while you're going through the spousal RSPs. The question really comes down to the limit to be used, which I believe you mentioned is the limit of the contributor, not of the spouse, because that's a common
Correct.
misconception. Like, oh, my partner's got all this room, I'll do a spousal and I'll use all that up, which unfortunately not how it works. So perhaps you can clarify that. Then if you could, maybe give a little more detail on that 3-year rule, because often when you get into the
Sure.
retirement phase, maybe just before retirement for a few years, you may have to adjust your savings plan because of that.
Great question. So when it comes to the contributions, first off, the contributor. So again, I'll use Clinton and his wife as an example because I'm picking on them at the moment. So Clinton is putting into her plan. Clinton is the contributor. That means it's using his RSP contribution room. He cannot go and max out the spousal and his own. They share the exact same contribution limit. So
Mm-hmm.
that's something to be aware of. The whole concept of spousal RSPs is to sort of equalize the RSP or the registered assets come retirement time so that both spouses have a relatively equal amount to draw from as a way of doing proactive income splitting. I'll talk about some income pension splitting a little bit later on, but this does tie to, especially if you retire prior to the age of 65, it's phenomenal way of doing some proactive income splitting that otherwise could not be maintained.
Yeah.
Now, when it comes to the 3-year rule, again, let's say I'll pick on Clinton and his wife again. Why not? So let's say they're substantially older than they are today. Let's say they're 55 years old and about to retire. Clinton just put in $50,000 last year to her RSP or spousal RSP, and now they want to start taking money out of the account. because that $50,000 was put in within the last 3 years, that money is called first out. So last in, first out means that that money is taxable back to Clinton, not to his wife's tax bracket. So not really a proactive way of income splitting if it didn't work out the way it was supposed to. So in, again, an ideal world, we would try to stop the spousal RSP contributions within about 3 years to retirement, just to make sure that that rule does not get in the way of the drawdown process.
Perfect. And as we're chatting, another question came in. Since I'm on the screen, I'll mention it. It has to do with income splitting.
Mhm.
Maybe you'll get to this a little later. If so, just mention that. But the question is, can income splitting on RSP withdrawal be when one spouse is 65 or older and the other spouse is still under 65? So if the ages are different, one over 65, one below, could you still do income splitting?
Great question. So it is, I will get to this. I do have a slide on it, but in the meantime, income splitting is based on the age of the account holder. So
Mhm.
if the person withdrawing the funds is over 65, then the income can qualify for splitting. Now, keep in mind, income from an RSP does not qualify for an income splitting. Even after the age of 65, it has to be converted to a RIF account first, and then you can take the income from the RIF, which qualifies for income splitting. Just little tricks that we do, and a little bit extra paperwork just to get that all done. But hey, it makes a big difference tax wise. So we have no problem doing that. And by we, I don't mean me because I don't do that paperwork. But I'm happy to give Clinton and Kevin more work on that
You
front.
pass the homework back every now and
That's
then. You
right.
give us a
Exactly.
few items.
Yeah.
Feel free to keep typing questions in the comment section if you have them there, folks. And Kevin and Adam will continue to go through the presentation. We'll pop in as we get more questions.
Excellent. All right, so a quick example here of how the tax savings would work for this particular client. So this example, client has $80,000 of earned income in 2023. They had $14,400 of RSP contribution room. Because this is for the 2023 tax year, they would be looking at their notice of assessment from 2022. So the one they would have received in spring of 2023, just to confuse you with more dates. The first $5,584 of RSP contribution would be at a higher tax rate. That is 37.9% is the amount that they would save on that first contribution. The next 88,000 and change would save 33.25% tax. So not every RSP contribution dollar in this case, because they are dropping a tax bracket, is getting a different tax savings as a result of it. So in this case, the 14,400 contribution would save just over $5,000 of refund potentially, or of tax bill owing, depend on which way to go. Now, you got $5,000 of found money as a result of this tax refund. What should you do with it? Again, Clinton and Kevin will gladly find a place to put it for you, but TFSA might be the next logical place to put those funds. You've maximized your RSP, and now you have this pot of, you know, after tax money that you can do something with. Well, TFSA might be a great place to park it. So again, TFSA, tax-free savings account, must be 18 years old, some provinces 19, and a Canadian resident. Annual limit, gone through that already. Contributions are not tax deductible. So unlike an RSP, you do not get a tax break on the money going into this account. It is after tax money that is going into the contributions. Excess contributions are subject to a penalty, just like an RSP over contribution. There is no $2,000 wiggle room, though. You can invest in all the same investments as an RSP. You are not stuck with just simple, boring savings account or GICs. You have all the same investment options available as if the funds were in an RSP. Um, you can have more than one TFSA, but if your TFSA is here, why would you need to have more than one TFSA? Non-residents can continue to hold the TFSA, but you can no longer contribute or you will be penalized. So again, if you happen to relocate down or to the States or to another country, you can keep the TFSA you have, but you cannot contribute further to it while you're a non-resident. So something to be aware of. Extra caution when it comes to this account, especially if you are a U.S. citizen, U.S. tax filer. This account is not considered tax exempt in the United States, and you may have to pay tax or have some additional tax filing requirements by having a TFSA. It may make sense, but most of the time we are not recommending this. However, chat with your cross border tax specialist to see what the impact would be if you wanted to have a TFSA and you're a non-resident of Canada, specifically a US resident. Continuing on the TFSA, so full amount of cash withdrawn will be added to the contribution room for the following year. So again, if you took $50,000 out of your TFSA before December 31st last year, you can take that out and you could put it back again as of this year if you wanted to. If you had a whole new pile of money, you do get that contribution room back. Best of all the income is considered tax-free in Canada. So again, not tax-free in the United States. Certain holdings may have some US withholding tax. However, otherwise in Canada, it is considered tax-free. So great account to take advantage of to get some tax-deferred growth, I should say tax-free growth. Again, it shelters income from tax, allows you to put more money away on top of RSP contributions. Money can be used for anything, and income is never taxable in Canada. Okay, so again, great account to take advantage of. Talk to your advisor if you don't have one set up and it makes sense for your set of circumstances. Now, because we didn't have enough acronyms and alphabet soup to deal with, we now have a new one. So, tax-free home savings account. So, not a TFSA, not an RSP, an entirely new account that you can open for a specific purpose. And in this case, it is for saving for your first home. Of course, there is qualifying criteria when it comes to this. Must be at least 18 years of age, not more than 71 years of age on December 31st of the year. Must be a resident of Canada. And of course, you must be a first time home buyer. Contributions are deductible in the current tax year or future tax year, but not prior like an RSP. So with an RSP, you have until the end of February, in this case, to contribute to the RSP and get a tax deduction for the prior year. With the FHSA, you contribute in February. That is deductible for 2024, not for 2023. And I believe somebody's come on here to interrupt me.
Yes, I have come to interrupt. I actually have a question that goes back a little bit to that sort of RSP rift scenario. We were looking into, if I'm already drawing from a RIF, does it make sense to make an RSP contribution if I'm still under the age of 71 to try and reduce taxes?
um, I'll give my favorite financial planning answer was it depends.
Yeah.
I honestly don't know. I mean, it would really depend on the set of circumstances. Age, you have the RSP room still. I mean,
Hmm.
that makes a big difference because you're not earning new room. If you're still able to contribute, you're legally allowed to if you have the room and you're below 71. It depends. Maybe you sold a rental property. Maybe there's a substantial
Hmm.
capital gain that you want to offset for tax purposes. Maybe you're trying to do some additional sheltering. If your spouse is younger and you might be over 71, you can contribute to their plan if you have the room. Again, it depends on the set of circumstances, but it is
Okay,
possible.
that
But for
sounds good.
most people that hit that drawdown phase, we're more concerned about how do we get the money out versus how we add more to the pot. So again, if
Exactly.
there is a unique set of circumstances, certainly reach out and we'd have to look at it. All right. So again, just continue on the tax-free home savings account, FHSA, new as of April last year. You can save up to $40,000 tax free to purchase your first home. The contribution limit is $8,000 per year. Carry forward only applies if you opened an account. So, if you are one of the folks that contacted us, let's say in December, to open the account before the end of the year, then you get to carry forward last year's contribution room. If you opened an account as of January 1st, unlike a TFSA, you don't get to go back for contribution room. Okay, so that's something to be aware of. Tax deductible contributions, it does not impact your contribution room. So again, when we say you have a $30,000 RSP contribution limit per se, this does not take away from that. You get to do both, which is fantastic. And the money is tax-free on withdrawal. So there's no obligation to repay this. Unlike the home buyer's plan, which is the way to access money from your RSP towards your first home purchase, that money has to be repaid over a 15-year time period. This does not have to be repaid. And best of all, if you're lucky enough to have money in RSP and in the FHSA, you can take advantage of both plans to draw money out for the first home purchase. Kevin.
Yes, another question's come in. Now, you've mentioned that the carry forward doesn't apply back to after you've opened the account. What is the rationale as opposed to, say, the TFSA, where if you don't contribute, you can build up all that room? Why can't you do the same thing for the first home savings account?
You're asking me for rationale as to the government's
Rationale
decision?
as to why, yes.
I have no idea what their rationale is on these
Oh,
things. I, I can make it up, but I don't think it would be very helpful. So I'm guessing it's just because it is such a tax advantage. They're just trying to prevent people just making a lot of contributions and open the accounts later just to dump the money in just to buy the house right away. So that's what I'm guessing. Just because it's just another it's another coffer that's lowering their amount of taxable income that they're getting at the end of the day. So
yeah. So
that's
just to
my
restate then,
assumption.
if I have the room, I didn't open it in 2023, but I opened it in 2024, I can only do 8,000. I can't do
Correct.
16.
But if you opened
Okay.
it December 31st, then you could do 16 on January 1st,
Okay.
just to
Perfect.
simplify it. As to what their rationale is at the end of the day, I have no idea. That's beyond me. Interesting question, though. Keeping me on my toes. I like it. All right. So certainly some of the most popular questions that I get, this slide and the next one. So what is the best option for your circumstances? RSP, TFSA, FHSA? Well, what is the purpose that you're saving the money for? Anytime we're looking at doing investing, we need to know what is the purpose. What is your income level? Because if you're making $20,000 a year, we might not be suggesting the RSP. We might be suggesting the FHSA. We might be suggesting the TFSA. Again, those are different options that we want to explore based on your income level. When will the funds be needed? If you're looking to make a purchase in the next 6 months, say of a car, we're not going to suggest putting the money into an RSP because that's a short-term cash need, and it would be far too taxable just to go through the hoops of putting the money in the RSP just to take it out for the car purchase. Will your income increase in the future? So again, people starting off early in their careers, yes, there is no necessarily wrong choice when it comes to putting money aside, but especially if your income level will increase over time, maybe some of that RSP room is better deferred for future years at a higher tax bracket when you can get more bang for your buck when it comes to your tax savings. Is there a wrong choice? No, there's no wrong choice. If you're young, getting started, just saving, of course, get expert advice when it comes to this. What works for you, or sorry, what works for your friends or family is not always the ideal solution for your needs. Everybody's got opinions when it comes to savings contributions. I'll call it the proverbial coffee shop talk. Not everybody has the same set of circumstances that works for them, right? So just because somebody didn't like an RSP doesn't mean it's not right for your circumstances, okay? It's all about getting the right advice for you. Should I contribute to an RSP or a TFSA? I left the FHSA out of this one because it's very specific and has a set purpose. Um, Ideally, the answer is always, the more money you can save, the better. Ideally, both. Use your RSP tax refund to put into the TFSA. It's great to have a balance of multiple sources to pull from in retirement. So a blend of having TFSA and also taxable RSP money is good in retirement. If you are saving predominantly inside a TFSA for retirement, please remember that that is your retirement money. and not, I see a shiny new car I want to buy money. Okay. Is your current tax bracket going to be higher than your retirement tax bracket? So I did allude to this earlier. The idea of putting money in the RSP, save this much tax, take it out, and pay a reduced amount of tax in retirement, or a tax bracket arbitrage, so to speak. I do have some rough guidelines here. Again, this is not set in stone. If your income is below 55,000, TFSA might be slightly more advantageous. If your income is above 55,000, RSP might be a bigger priority for you. And again, as I mentioned earlier, my favorite answer is it depends. First of all, let's do a financial plan. Let's see what is the right investment account for you. What is the right amount that you should be saving towards your goals, whether that's short term buying a house or whether that's long term towards retirement. Let's make sure that we're optimizing that for you. I do have a couple scenarios here just to show you the impact. Now, this may be tiny in your screen. I'll admit the chart doesn't look as pretty as I was hoping it to, but this is really showing if you save the exact same amount between RSP and TFSA in a particular tax bracket, where are you going to get your best bang for your buck? So here's an example. A young couple in a 37% tax bracket today, they're contributing $250 a month until retirement, and then withdrawing from their accounts at a lower tax bracket than they're at today. Again, it doesn't look like there's a big difference between the lines, but again, you are getting a slight advantage on the RSP contributions when you're taking income out later on. That's your overall income situation is better than if you just invested inside the TFSA. Again, this is a quick example. I'm not going to go through all the numbers on the screen. It's just a way of showing how the calculations were completed. Secondary scenario. So what happens if it's that exact same couple, but they're in the same tax bracket today that they're going to be in retirement time? In this case, the TFSA appears to have a slight advantage over the RSP. Again, so they're not getting the tax savings today, but they're not paying tax when they take the money out later on. So again, that's where I talk about the tax brackets and really trying to figure which makes the biggest impact long term for your overall tax savings. And then final example on this one is a slightly more dramatic. Let's say they're at 43% tax bracket today, taken out at 33%. That means a 10% difference in tax bracket between contributing and withdrawal. So as you can see, the RSP redemptions do take a significant bump over the TFSA redemptions. Again, that's just a way of looking at this, showing the power of that tax bracket savings throughout your lifetime. All right, income splitting. We did briefly talk about this earlier on. Again, it's my job when building a financial plan. I want to try to keep both spouses in a very similar tax bracket in retirement time. And one of those things we can take advantage of is income splitting. Before the age of 65, the only income that we can use for income splitting is the defined benefit pension plan. Doesn't matter how much RSPs you have, how much RIFs you have. If it's all under one spouse's name, it's all taxed to that person when they take the money out. So again, that's where we talked about the spousal plan being an important proactive tool in the toolbox to pull from. So that way, if Bobby and Susie each have $300,000 in each of their accounts, they can at least take out even amounts prior to the age of 65. If Bobby had, most of the assets under his account prior to the age of 65, all of that taxable income has to go to him instead of being split with his spouse. So again, income splitting can make a huge difference, especially for those retiring prior to the age of 65. Certainly more options are available for splitting income after the age of 65, defined benefit pension, the RIF, the LIF, the LRIF, because again, we didn't have enough acronyms to chat about today. Annuities, taxable portion of certain annuities. So again, those are things that we're looking at. RSP withdrawals do not qualify for income splitting. So, which is why Clinton or Kevin may suggest that we convert an RSP to a RIF account to start that drawdown process. So that way it is splittable.
Okay, we have more questions coming in. We do try to answer some of the questions by replying to the comments in the comment section. So if you Didn't see Adam talk about it. Likely there's a reply already in the comments waiting for you. But a new one that just came in here, Adam, and I imagine we can tag team this one. The question has to do really with investments as it relates to taxes. For example, buying a corporate class ETF as part of a strategy, perhaps to lower your overall income on a non-registered account. So maybe you avoid the OAS clawback or get some other government benefits because of that. And they asked in general, is that a good idea? So if you want to talk kind of on the financial planning piece, and I think we usually start with the plan and the goals, and then that leads into the investment. But I'll
Perfect.
let you
Well,
start, and then I'll add
I'll,
to it
I'll
as
do a
well.
little bit, and then I'll make you do the bulk of the work on this one.
Sounds good.
It does come down to, again, building a financial plan, looking at your overall financial picture, where all the assets sitting, what room do you have for TFSA? If you have a large pot of non-registered cash, what makes the most sense to invest that strategically? And again, we're looking at just the tax planning side and the drawdown side. Do you have the liquidity? Do you need those funds? Does a tax exempt whole life insurance work as part of the mix? And of course, when it comes to tax efficient investing, especially on non-registered accounts, that's where Clinton and Kevin would come in to make sure that they're picking the right investment. I'm sure each one has some pros and cons, but I'll let Clinton chat about that further.
Yeah, I will. So it starts with a financial plan. The idea that there's like a one size fits all answer is simply incorrect. It really is nuanced depending on your situation. And then on the investment front, you always have to talk about risk. There's always a trade off with investments. So if you're getting a benefit or a feature somewhere, you're probably going to have to give something up somewhere else in order to get that benefit. And that is certainly true when it comes to corporate class investments, because they're very rare that you'll find a corporate class investment on a low risk strategy, for example. It's hard, just the way they're structured, to get fixed income and get enough of the write offs to handle the interest. That's getting into the nuances of how those are structured, but you tend to find more of the corporate class in your medium and your growth strategies, very few on the low risk side. So that really wouldn't be applicable for everyone. It really depends on the risk tolerance. And then the second piece I'd mentioned that you already commented on was the withdrawals. If you're taking the money out, this strategy really won't help because you'll be cashing in those investments and you'll be realizing the tax anyway. And if you don't need the funds, well, Adam mentioned a lower risk option there, which was a whole life insurance for non-registered funds that could be a better fit. So lots of options there. There is no one size fits all, no magic solution. You have to start with a plan like Adam talked about. And then if you have the non-registered funds, you have to consider your withdrawals, how it works with the plan. And most importantly, for investments, you really have to consider the risk to make sure it's going to be a good fit. And as we're rambling there, we got another question kind of related, but more on the RSP side. The question is, should I try to have RSP totally withdrawn before you die? Well, my joke is always that you don't want to die with any money in your RSP. Ideally, you got zero in the RSP, but that again likely will depend on your overall strategy. If you have a really big lump in the RSP, it just might not be practical. But I think a good goal would be to reduce it as much as you can. Would you agree, Adam?
Ideally, that is the goal when we're trying to build a plan. We're trying to draw those down as effectively as we can, which does lead to my next topic, which I'll talk about here shortly. But again, it's
Talk about a
trying to
segue.
try. I know, great segue. It's like we paid for that question. But yeah, it is trying to melt down those accounts and take that money out so that your estate isn't forced with a large amount. Obviously, we don't know how long we're going to live for. We don't know any of that because if you did, that would make my planning job much easier, and I would know exactly what time frame we have to draw this out. Um, Ideally, we want to be proactive. We want to take advantage. Well, as an example of a couple, we have both people that we can split that income in versus if one spouse passes away prematurely or we leave the pot of money too long, we no longer have two tax brackets that we can split that income on. And all of that income is taxed then to the survivor. I mean, that's an entirely different conversation from today, but again, that would be food for thought. When we do look at a meltdown or a drawdown strategy for accounts, we want to look at what order do you draw down and access your retirement nest egg. So the question that was asked earlier, you got a lot of non-registered money, perhaps you have some RSPs, you have some TFSAs. What account makes the most sense to take out of first? Often, maybe a misconception is people think that they don't need to or shouldn't take money out of their RSP or RIF prior to the age of 71. So, a reminder, age 71 is when you have to convert all of your RSPs to RIFs and start a mandatory payment. And I think I have a slide coming up on that as well. But it may be advantageous to start taking out of it sooner. Perhaps if you've retired at 62, we're going to start suggesting that you start melting down that account earlier on. That way you don't have the estate problem or estate tax bomb, as some people call it, with a large amount in your registered account that you have to pay tax on at probably a high tax rate. Should you take RSP money before your corporation? Again, if you have a corporation, we would look at that, what your tax brackets are and how that might change in retirement. And as Clinton mentioned, everything comes down to the plan. We want to make sure that we are doing a proper analysis, looking at your whole picture and trying to optimize that as best as we can. Okay. Meltdown strategy. Again, just a quick example here. Let's say your taxable income for 1 year is 71,000. Your income level will likely stay consistent year after year. Does it make sense to draw extra from your RSP? In this particular set of circumstances, it's a prior year's tax bracket. Mechanics are still the same regardless. It's really just saying, okay, you have extra room in that tax bracket that goes up to 79,000. You have room to take $8,600 out extra without bumping up to the next higher tax bracket, which is 37%. So you could take that amount out, you know the amount of tax you're going to pay on it, and you can always put that aside into your TFSA after tax. And that's just another way of being proactive in taking the money out of your registered accounts so you don't leave a big tax problem for the estate down the road. If you're married, common law, you both have a similar income level, because we've already talked about some income splitting, you could draw out an extra $17,000 between two of your RSPs, and again, shift that extra money to the TFSA. In again, ideal world, we want all of your wealth or most of your wealth to be sitting inside a TFSA by the time you pass away, because that just leads to a more tax efficient estate. Again, talked about this, but what do you do with that after tax money? TFSA, tax exempt whole life insurance, non registered account. What if you decide to defer extra withdrawals a few more years? RIF minimums may force you into a higher tax bracket, perhaps a higher likelihood of OAS clawback. One spouse passes away prematurely. I've already chatted about that. And of course, if you have too much left in the estate, maybe it's taxed at 50%. And the whole point of putting the money in RSP kind of went out the window because now you're pushed into a higher tax bracket. So I always say, wouldn't you like to be in control of how much taxes you're going to pay? You're in the driver's seat choosing essentially which tax bracket you're going to be within. RIF account. So again, we're looking at the drawdown. We are nearing the end of the presentation, a couple more slides to go. RIF account. So what is a RIF? Registered Retirement Income Fund. So this is the account that your RSPs get converted to. So essentially all of your investments just change the acronym that's on the account from an RSP, which is the deposit account, to a RIF, which is the withdrawal account. Think about it that way. Do I have to take it all out by 71? No, you do not. All of your RSPs have to be converted to a RIF, and then the minimum payment starts the year after. Here's a quick table as to how the minimum payments work. So, example, at age 72, you have to take out 5.4% of the balance on January 1st as your minimum payment. So that is the minimum amount of income you have to take out and pay income tax on. That percentage does slowly creep up year after year until you're 95 years old and you're taking out 20% year after year. But again, your balance has probably been depleted by that point in time. What investment options do I have for my RIF account? You have all the exact same options as if it was in your RSP. Again, we're just moving everything over from account A to account B and really just changing the acronym that's on the account. If you have concerns on the investment options, of course, chat with Clinton and Kevin. Make sure that they have the right options for you. And if you're in drawdown mode, you also want to make sure that you have the liquidity needed to handle the drawdowns for your cash flow. What other options exist? Well, you can convert RSPs to annuities. Um, there's also lifts, RIFs, PRIFs, all that just really depends on the account type that the money was in to begin with, okay, such as locked in pension money. All right, retirement income planning. So we want to look at when we're doing the plan, what resources are you receiving income from? So we're looking at how all the different moving pieces tie together to create that cash flow. Essentially, replace your paycheck from work. CPP, old age security, private pensions, registered accounts, non-registered rental incomes, corporate income. How do those all work? How are they each taxed? And how does it all go into the bank account to create that cash flow for you? So that way you can just enjoy the retired life, maybe play some pickleball and not have to worry too much about the day-to-day where the money's coming from. Essentially, that's what we're all here for, is to manage that for you. Two sides to the coin. How much do you want monthly, and how much makes sense tax wise annually? So, first, we want to make sure that the money's going to your bank account every month. So that way, you can just enjoy the good life in retirement time and not have to stress about, making sure that money's coming in. And then the second one is, how much extra, perhaps in your tax bracket, does it make sense to take out of the account just to pay tax on and perhaps shift aside to the TFSA or non registered account? So there's two different sides to that we all want to make sure is addressed. What's the magic number that you need for retirement? I have no idea what the magic number is that you need for retirement, but let's figure it out. Let's build a plan. Let's map it out. Let's go through the budget. Let's look at the numbers. Let's look at all your different sources and find out if that number is achievable or what you can do. What is the type of account that you need to invest in today to make sure that that happens? And of course, that comes down to bespoke solutions. We do want to build a financial plan. Um, I let the plan do a lot of the talking for me to make sure that we're truly looking under the hood. We're looking at all your unique set of circumstances. What are your goals? What do you want to achieve out of this process? And how can we help you do that? And through a financial plan, it's a valuable financial roadmap. We all use, GPS to get around these days. The little person on your phone yelling at you, telling you made a wrong turn. That's my job, is to point you in the right direction and help you stay on the right road and get towards your destination as efficiently as possible. And then that is it for my section. If Clinton and Kevin are still awake, they'll come back on.
We
And
are, we
if
are.
there's any additional questions that we haven't answered, then
Awake and riveted,
yeah,
Adam. We were riveted
excellent,
the whole time.
excellent.
We're ready for another hour.
I will mention we do have a
Yeah,
full
that is
YouTube
entire
channel, and we got lots of videos on those topics on the YouTube channel. So if you want a deeper discussion there, you can either reach out to us with chatwithclintonkevin.com, or you can certainly go to our YouTube channel and get some more detail with one of the videos on those topics.